Good afternoon, everyone. My name is Emmanuel Attah Kumah Amponsah, a senior lecturer and head of department of accounting, banking, and finance from the Ghana Communication Technology University. Anyway, I studied in India. That's why I did my master and my doctorate. This paper was written by 5 co-authors. We came together to write this papers, and you can find their names there. We all know the issues of corporate governance and financial performance. These have been a global issue, the corporate governance and the performance of the business. Our focus was a case study on the corporate governance, the effect of corporate governance on financial performance of SIC, and that is State Insurance Company, the name of the state company, insurance company in Ghana. These are some of the 3-star studies who have done research about it and raised this concern. Some of the conceptual reviews under this study were corporate governance, financial performance, with the financial performance review on the return on asset and the return on equity. Some of the theories we used are agency theory, stewardship theory. The methodology employed descriptive study was designed to execute the study. The research approach used is the quantitative approach. And then the study period, that spanned from 2010 to 2022. And then the estimation strategy for this study undertakes stationary test, co-integration test, ARDL limit, that auto-regressive distributed lag, then diagnosis test, that is the auto-correlation and heteroscedasticity test. Variable description, measurement, and expected signs. So the variable used for this study, with the dependent variables, we use the financial performance, and it was measured using that is the return on asset. The study derived the return on asset by dividing the net income of the SIC by its total asset. Then the independent variables, one of them was board size. That the number of board members, as mentioned in the SIC's financial report, serve as the basis for this study's calculation of the board size. Then the board composition. Board composition was derived through scoring each year's board members' reported educational background, expertise, the diversity and gender grouping over 100%. And then the CEO tenure. The study calculated CEO tenure using years, that's the yearly report that represent the CEO in office was counted as part of his tenure. Discussions. This is the statistics of the variables. And this is the interpretation. Firstly, the mean return on assets. The mean return on assets stands at 1.9531, indicating the average profitability and efficiency of these firms in generating earnings from their assets. Secondly, the board composition with a mean of 2.0040 suggests a moderately diverse mix of directors and their qualifications in overseeing company affairs. Furthermore, the board size averaging at 2.0261 suggests a relatively moderated size board of directors involved in decision-making processes. CEO tenure with a mean of 1.916 signifies the average during CEOs have held their positions, reflecting stability or turnover within leadership. Lastly, the mean firm size at 2.1464 hints at the company's scale and magnitude in terms of revenue or market capitalization. These metrics collectively offer insight into the financial health, governance, leadership stability, and overall size of the sample firms. Results of long-run relationship. The study evaluated the long parameters from ARDL 11111 based on archive information criterion, since the bounds test results verify the presence of long-run connection. The data in the tabulated indicated that the board size coefficient was 0.3627 and the probability was 0.6597. Based on the findings, it may be concluded that board size did in the long term have a favorable impact on return on assets. However, the probability was 0.6597, which was over 0.05. Therefore, it was not significant. On the whole, it can be concluded that SIC's economic overall performance isn't significantly impacted by means of the size of the board. The findings are consistent with research by A.L. Makui, Pilla, and Hossein, 2016, and Asha Murray and Shaka, 2018, which claims that board size has no appreciable impact on financial success. Also, the board competition coefficient was 0.0182, and the probability was 0.9665. Based on the findings, it may be concluded that board size did, in the long term, have a favorable impact on return on assets. But because the chance was 0.9665, which was more than 0.05, it was negligible. It might be concluded that over time, SIC's financial performance is not significantly impacted by the board's membership. The study's findings were consistent with those of Chire and Olu's 2021 research, which determined no evidence of a connection between board makeup and economic achievement. The CEO tenure at the company coefficient was negative 2.1242, and probability was 0.0597. The findings suggest that over time, the CEO stays at the company had a considerable negative impact on return on assets, as the probability was 0.0597, which was greater than 0.1, and made it inconsequential. It was significant that at 10% level, it has a detrimental impact on the company's financial success. As a result, over the long term at SIC, there is 2.1242 decline in return on assets, the financial performance, for every unit increase in CEO tenure. The opposite is also true. The findings are consistent with a research by Maggi and Morigu, 2015, that suggests that over a certain threshold, CEO tenure may have a detrimental impact on financial performance. The control variables used in this study was firm size. Based on the long-run results, firm size had a coefficient of negative 62.030 and had a probability of 0.000. This meant that firm size had a poor large effect on return on assets at SIC in the long run. The effect was significant at 1% level because the probability was below 0.01. Thus, 1% increase in firm size would cause a 62.0030% decrease in return on assets at SIC in the long run. And the inverse is true. The result went contrary to studies done by Chen, Yu, and Wang, 2015, and Adams and Harwick, 2015, that suggests advantageous relationship among company size and economic overall performance. The study that backs this result was Zheng and Wu, 2015, study that found a non-linear relationship, suggesting that the advantageous impact of organizational period on financial user overall performance diminishes at the firm size becomes excessively large. Although it does not back the result directly, it implies that a negative impact of firm size could be a result of the firm becoming too large. Now, I'll just move straight to the recommendations. So the conclusions. The analysis revealed that the variables had a long-term equilibrium connection. The study revealed that in the long run, board size had little influence on financial success at SIC. Furthermore, the study revealed that board composition had no long-term influence on SIC's financial success. In contrast, the study indicated that CEO years at SIC have a considerable negative influence on long-term financial success at SIC. Recommendations. Firstly, the study concluded that board length does not have a tremendous impact on economic overall performance in the long run. Therefore, it may be worth considering increasing the board size temporarily to potentially improve short-term financial performance. By expanding the board, SRC can benefit from a wider range of perspectives and expertise, which can purpose greater effective choice-making and advance financial outcomes. Secondly, the study found that board composition does not have a vast effect on financial overall performance at SRC. This suggests that focusing entirely on composition as a determinant of financial performance may not yield the desired result. Instead, it is important for SRC to prioritize other aspects of board effectiveness, such as diversity, skills, and expertise. By ensuring a diverse and competent board, SRC can leverage a broader range of knowledge and experience to drive better financial performance. Furthermore, the study highlighted the significance of, thank you. The significant effect of CEO tenure on financial performance at SRC in the long run. Based on this finding, it is recommended for SRC to prioritize stability and continuity in CEO leadership. Long-serving CEOs often possess in-depth knowledge of the company and industry, and their experience can positively impact financial outcomes. However, it's crucial to periodically evaluate the performance of the CEO and ensure that fresh perspectives and innovative ideas are incorporated when necessary. Lastly, the study discovered that organization length had a negative great effect on return on assets at SRC in the long term. This indicates that as the company grows, there may be challenges in maintaining optimal financial performance. It is imperative for SRC to closely monitor and manage the impact of increased firm size on operational efficiency and profitability. Strategies such as streamlining processes, improving resource allocation, and fostering a culture of innovation and agility can help mitigate the negative consequences of business enterprise duration on economic standard performance. Thank you.